I'm an advisor with Egan Berger Warner, and our webinar today will be for a 2020 market outlook. Please take a couple moments and read the following disclaimer. Okay, it is my distinct pleasure today to introduce Elizabeth Grenfell. She's a vice president and a member of BlackRock's U.S. ETF investment strategy team. She joined BlackRock from Yum Brands Incorporated, where she spent 4 years as a senior member of the finance team. Prior to that, Elizabeth was covering aerospace and defense companies at Bank of America Merrill Lynch, where she was responsible for both evaluating investment opportunities and conveying these to external clients. She holds an MBA from Columbia Business School, where she was on the dean's list, and she has a BA in economics and mathematics from Washington and Lee University. So it's my pleasure to introduce Elizabeth.
Hi, and good afternoon, everyone. Thank you so much for taking the time to join us today and for letting me share with you BlackRock's market outlook for 2020. If we could go to the next slide. Couple more. One more. Oh, there we go. Great. So I would like to start, before we delve into what we're expecting for 2020, by looking first at what happened in 2019, as I think it really sets the stage for how we're expecting 2020 to play out. And what you can see on this chart here is ETF flows in 2019 on a monthly basis, split by commodities, equities, and fixed income, where commodities are represented by the green line, equities represented by the pink line, and fixed income represented by the blue. And there's a few takeaways from this slide. The first is that we saw consistently positive flows into fixed income every month last year. And by the late summer period, fixed income flows actually represented 60% of total ETF flows. The pink lines, however, representing equities, actually tell somewhat of a different story and show the fact that there was a lot of volatility last year around trade policy. So we saw a significant sell-off in ETF flows in May and August, around the same time period that in May, Trump had his tariff tantrum, and in August, where discussions between the US and China fell off again. However, as you can see from September through the end of last year, and the trend continued into January, so you saw positive flows into equities and fixed income again in January, you saw a pickup there as the trade one negotiations began to take hold, and as investors really took to heart the fact that they thought that there was going to be an impasse between the US and China with regards to the trade negotiations and the back and forth volatility that we'd seen earlier last year. The anticipation was that this would unlock growth that had been put on the back burner in 2019, and that business investment would also follow through. So by the end of last year, flows into equities reflected about 50%, over 50% actually, of total flows into ETFs. Now, I will highlight the fact, before we go any further, that we put our 2020 outlook together back in December, so before the outbreak of the coronavirus, which is obviously whipsawed market. Last outlook as the duration and the extent of the epidemic caused by the coronavirus is unknown, but we do expect it to be short-lived, and typically when you see these types of outbreaks, you see a V-shaped recovery. So we expect this to be a blip at the beginning of the year, but for the rest of the year to hold true to our forecast as of now. If we go to the next slide, what you can see is flows again, but here we look at flows across our factors, so across min-vol, momentum, quality, and value. And you can see, as represented by the green line, min-vol flows last year really dominated factor flows, and that this was then followed by momentum, quality, and value. As we look to 2020, and you can see a continuation of this that started to take hold at the end of last year, we've seen flows into quality significantly outpace flows into other factors. And in fact, flows into min-vol have been negative year to date. Now that's not representative of performance because performance for MinVol has actually been quite good. But in terms of flows, we've seen flows into quality, followed by value, followed by momentum, followed by MinVol for 2020. We're going to get into this a little later, but that is consistent with our view for 2020 as we upgraded our view on the quality factor and expect it to outperform in 2020. If we look at the next slide, what this shows on the left are our 3 key investment themes for 2020. And on the right, 12-month and 3-month performance across asset classes. Note that this was as of December. However, I think that the point is still the same, that in 2019, we saw really strong performance across asset classes. And I think if you were to back up 12 months from now and back to February of 2019, you probably would have been hard-pressed to find many that would have expected the S&P to have total return of nearly 32%, the NASDAQ to return 35%, the global ag to return 8%. It was a really strong year across asset classes. And there were 2 things that drove that performance. The first was central bank policy, and then the second was trade policy. And with regards to central bank policy, we saw the Fed cut rates 3 times last year by a total of 75 basis points, which I think, again, if we were to have backed up to the beginning of last year, you would have been hard-pressed to find many who would have anticipated the central bank would be so accommodative, more so to what was happening in the global landscape and less so to what was happening here in the US, because besides inflation, which has been running below target, the business outlook and wage growth, unemployment, et cetera, has all been doing pretty well here in the US. So those are the 2 things that drove performance last year. And as if I take a step back and look at, all right, well, what were our 3 key themes back in mid of last year, so last July? They were distinctly different than the 3 themes you see up on the screen here today. We had expected continued protectionist push. We expected the Fed and other central banks to continue to stretch the cycle. And we were really advocating for raising resilience in one's portfolio. But what got you here won't get you there. And as we look towards the rest of this year, our 3 key themes are growth edges up, policy pause, and rethinking resilience. And I'm going to delve into these in a little more depth in a few minutes. But before we do that, I want to hit on what that actually means. So for growth edging up, we expect that the significantly easy financial conditions that were put into place last year, primarily by central banks, will cause an inflection point in growth in 2020 in the first half of this year. That doesn't mean that growth goes haywire and just explodes. We expect it to return to trend, but we do expect to see an inflection in growth. That means we do not see the risk of a recession in 2020, and we see a return to sort of this 7th inning stretch of being in the late stage of the economic cycle. With regards to policy pause, we think that the Fed is on hold for 2020, and that if you see any sort of central bank cuts, it would likely be out of places like Japan or the Eurozone. But the Fed has come out explicitly and said that they, barring any significant downturn in financial conditions, are going to stay put for now. I think if anything, they could stay put and let inflation run hot to their 2% target, as it's been below target for quite a while now. And then third, rethinking resilience. So, we think it's really important to maintain exposure to treasuries in one's portfolio, but we do see risk to the upside for inflation and would advocate for tips in one's portfolio. And we think it's important to consider the fact that outside of the US, many central banks' interest rate, rates have reached what we call their lower effective bound. And what that means is that they will not necessarily have the same impact from further cutting rates on the economy that they would have had historically, because they are either at negative rates or so low. In the US, we have not reached that point, but the problem becomes when you get to that lower effective bound, the correlation between equities and fixed income does not justify the 60-40 portfolio that people usually build their portfolios around. So here in the US, we still are advocating towards a 40% exposure to fixed income, but we maintain our, the importance of having treasuries in one's portfolio as ballast. but we would argue that outside of the US, that is less so the case. So now let's delve a little more deeply into what we mean by growth edges up and the other themes. This market view slide, before I get into that, is a lot of words on one screen. The big takeaway here is that we are more bullish equities than we are fixed income in 2020, and that within equities, we are more bullish on Japan and emerging markets than we are the US or Europe. That is primarily based on the fact that we expect the thawing of relationships between the US and China, and combined with the fact that we think that manufacturing is going to have a rebound for cyclical assets to outperform. So for example, about 20% of Japan's exports go to China. So we think that as China returns to better growth, that Japan should be a direct beneficiary. And we think that as the global economy recovers, emerging markets should also be direct beneficiaries, in addition to the fact that we think central banks outside of China are likely to continue to cut rates, which supports growth in equity markets. Within fixed income, we are more bullish on high yield and emerging markets, predominantly because of the yield differential that they provide versus, say, fixed income. We'll get into that in a little more detail in some following slides. So let's go now into growth edges up. As I mentioned earlier, we think there is limited recession risk and the expansion remains intact in 2020. And in fact, we expect a modest pickup in global industrial production and trade, which can pave the way for cyclical assets to outperform on a tactical basis. As you can see on the chart on the left there, what it shows is where you would expect GDP growth to be based on the financial conditions, which is represented by the green line, and then where growth is actually by consensus expected to be with the pink line. And what you see there is a really significant gap between those two measures. And I think that's really attributable, for the most part, to the chart that you see there on the right. So we would have expected potentially the impact of the financial conditions to provide more impulse than it has to date. And we do continue to expect that to flow through to the economy, especially in the first half of this year, but potentially not to the same extent that it would have in the past because of the heightened geopolitical risk environment that we're in. On the chart on the right, you can see with the green line, the global geopolitical risk, and with the pink line, the US-China risk. And if we were to add another line and add in Gulf tensions, it would actually be heightened compared to US-China. What all this means is that we know markets don't like uncertainty. And we think that although we have come off recent peak levels, that political risk does remain elevated. And that is a headwind to growth. So we think that this impasse that the US and China have reached will sustain through the rest of this year, especially past the November elections, as it doesn't behoove Trump to escalate tensions there any further, and it doesn't behoove the Chinese to either, given their economic backdrop that they're dealing with outside of just the coronavirus issues. However, I would note that we do think in general that the risks as it regards to cybersecurity, as it regards to North Korea, and as it regards to Gulf tensions are underappreciated by the market. Nevertheless, we do continue to expect that pickup in growth. We expect it to be manufacturing led, and we think that business spending should start to pick up. If we go to the next slide, what you can see here are equity, back one. Yep, right there. What you see here are equity earnings revisions. And the takeaway here is that the 1 month, as represented by the green line, is outpacing the 3-month revisions as represented by the pink line. Now these two charts specifically that you see here are from November of last year, but I just reran this last week and it showed the exact same thing. So it's showing that we're seeing improved sentiment, particularly among cyclicals, but also in the US and developed markets. We've seen fourth quarter earnings come in modestly better than expectations. We've seen guidance raised, and we've seen as a result earnings expectations lift for 2020. We have seen as it regards to flows, cyclicals also outperform defensives year to date, and all while that has slowed down a little bit over the last week given the coronavirus, we would expect that to continue as manufacturing seems to have reached its bottom and has started to rebound. On this chart, you can see this continuation of the cyclicals versus defensive theme that we're talking about, how cyclicals are outperforming defensive recently, and how global manufacturing PMI, represented by that pink line on the left, we do think has bottomed. So if we think about the returns we saw in equity markets last year with the S&P up 31.5%, the question is then, all right, what drove that? And really, the majority of that performance came from multiple expansion. And the driver of that multiple expansion was the fact that the Fed cut rates 3 times. So the question then becomes, well, if we don't expect the Fed to cut rates again in 2020, where are equity returns going to come from? And we think they have to come from fundamentals. So you can see on the chart on the right, current consensus for the S&P is for earnings to grow about 9%. However, for example, for emerging markets, the forecast is for earnings to grow almost 15 percentage points. We think, furthermore, that Japan there, which looks pretty low at 5%, has potential to outperform that if this manufacturing rebound doesn't gain some traction and gain some footing, and that it could exceed that. So the chart on the left here shows how bearish sentiment and positioning could actually continue to provide upside for risk assets. So the chart on the left there, what it does is if you take below 0, it's a bearish risk appetite, and above 0 represents a bullish risk appetite. And the takeaway here is that for most of last year, we were really in a bearish risk appetite environment. Now, that's not what you're seeing in terms of returns, but it was more in terms of total flows. And those flows were across 13 broad asset classes across low, medium, and high risk. And then we measure and adjust the flows for size and vol using a 2-year Z-score. So we then compute a rolling beta to the MSCI ACWI, and we compute this risk appetite indicator for each day. The point being here that you can see as of lately, we saw a significant shift into heightened risk appetite, and we think that that continues into 2020. On the right, you can see with the green line there flows into cyclicals and the pink flows into defensives. And I hit on this earlier, but starting in September of last year, when we start to see this defrosting of relations between the US and China, you saw risk assets perform and you saw flows likewise into cyclicals start to pick up, and you've continued to see that into 20, where cyclical flows are handily outperforming flows into defensives, which has actually been negative year to date. We expect the yield curve could likely bear steepen, so long-term rates would rise faster than short-term. And in that sort of environment, you actually see value outperform. So the chart on the left here shows you total return across the course of last year across the different factors. And you can see a significant pickup in value starting at sort of the last 4 months of last year, similar to what you saw with the flows into cyclicals, similar to what we saw into flows into equity ETFs, really a change in sentiment that marked the last quarter or plus of last year. So if we do see a bear steepener over the course of this year, we really think that it could unlock the potential for value to finally get its turn and to outperform despite the last several years where we've seen underperformance there. And then finally, in the last slide on this section, is just that we continue to expect to remain in the US in this late stage of the economic cycle, which is represented by the yellow line on the left. We entered that in the 3rd quarter of 2018, so we're going close now to almost 2 years of being in this late stage, which seems to be in this sort of never-ending stretch, and it's unclear what would cause it necessarily to stop, as we think that we are getting to a point where growth will see a stronger inflection this year. But that being said, when you are in this stage of an economic cycle, Typically, quality and min-vol outperform, which is consistent with our upgrade of quality coming into this year, and actually consistent with the performance we've seen year to date. So policy pause. So I'd like to start when we talk about policy pause by talking about where we're seeing central banks do, not just here in the US, but on a global basis. And what you can see here across central bank policies represented by the blue line with the Fed, the green line with the Bank of England, the ECB with the pink line, and then the BOJ with that sort of yellowish orangish line. And you can see that last year we really saw a shift to a much more dovish policy on a cumulative basis across all four of these central banks. We think that the Fed will remain on hold in 2020, although the market is pricing in one cut this year and close to 2 cuts in the current Fed futures contracts. But we do think that the Fed is on hold, and as they have explicitly stated. The BOE last week kept rates at 75 basis points, so a dovish hold, and they explicitly pointed out that they had seen early signs of stabilization in global growth, and that it's leading to a pickup in investment intentions. So again, hitting on that sort of this turning point that we think we are in with regards to global growth. Again, if we do see any sort of monetary easing, we think it could come out of the ECB or out of Japan. However, with rates already negative in those two places, it'll be interesting to see what they do. So then the question then becomes, all right, if you've reached these lower effective bounds and monetary policy no longer has the impact that it had historically, what do you do? And that's why we think that the conversation is actually going to shift to fiscal policy and fiscal stimulus. And in the next downturn, you're going to have to see some sort of combination, for example, here in the US, of fiscal and monetary policy working together to get us out of a downturn. If you look at the next slide, what you see is fiscal impulse from the G3 and from China since the early 2000s. The point of this slide is that we think that this slows down in 2020 in the US. I think that any sort of fiscal rhetoric will be, or any sort of fiscal policy discussions will be overshadowed by the US election and the US election rhetoric. We think that you could potentially see some impulse from China, but other than that, it's somewhat limited. Although we do think that even a moderate shift towards fiscal easing may have an outsized market impact. So at this point, we think that fiscal is going to have a better impact than monetary, but at this point, we don't see any drastic fiscal policy across any of these four zones. If we look a little more deeply on the next slide into China, again, I think that China's policy outlook is limited. They have gone from an economy that was really a credit-intensive growth model to one where they're trying to shift away from that. So their monetary policy has really tightened by their crackdown on shadow bank activity and is being eased modestly via broad-based cuts to bank reserve requirements, a new prime rate lending mechanism, and a cut in rate in the PBOC's medium-term lending facility. But that being said, they really are trying to gradually shift as the economy continues to rebalance and as their aging society starts to weigh on their growth. Investment is still supported by infrastructure and real estate. So we think that, but we do believe that China's government has a diminished appetite for the sort of large scale stimulus that boosted growth and that you can see here in past downturns. Instead, the government is emphasizing leaner and cleaner growth driven by consumer spending and private enterprises instead of the traditional channels. And then finally, our last theme of 2020 is rethinking resilience. And I think the first thing to hit on here is the chart on the left shows how in an inflation shock, what happens is the benefits of diversification are undercut. I mentioned earlier that we think that the combination of wage growth, 50-year low unemployment, and the risk of deglobalization, which would cause a supply shock, really are a risk to inflation being to the upside and a change to the sort of the equity bond correlation that we've seen over the last 20 years, which has been the real advocate for the 60-40 portfolio. With that in mind, we do think that tips are an important piece of solving for this, as they do outperform in both inflation shocks and they perform positively in growth shocks. So depending on what sort of backdrop we end up being in, they would provide a source of resilience in one's portfolio. On the chart, on the next chart, you can see on the left, to get to that sort of 60-40, go back one. Yep. To get to that 60-40 allocation overall, it's based on the sort of looking at a correlation of -30 basis points between equities and fixed income. If we take that correlation to 0, the allocation to fixed income actually drops to in about half, to 20%. So we don't think that this is a risk here in the US, and we would still advocate having treasuries in one's portfolio to cushion against equity downturns. However, outside of the US, we do think this is becoming a larger concern. And so we think it's important to keep an eye on that and to think about ways to add resilience to one's portfolio if that correlation does indeed decline. My last slide here is on the importance of income. And I spoke earlier about how we had upgraded our view on emerging markets and high yield. And the chart on the left shows you the yield differential between emerging markets, local hard currency, and high yield versus with the pink line, investment grade. And you're really getting almost 200 basis points of yield pickup through emerging markets or high yield. We think that the risk of default for high yield remains low, and we think that with emerging markets, central banks likely to continue to cut interest rates in 2020, that should provide a positive tailwind to their debt. Furthermore, we expect the dollar to stay sort of where we are, if not weaken, which further provides upside momentum to emerging market performance. So really, this is somewhat of a call on central banks and their actions, but it's also a call on the fact that we think that the coupon that emerging markets and high yield provide investors that yield that they're looking for. The chart on the right shows across, for example, investment grade, the 2- and 10-year treasury, investment grade, European high yield. You can see on the far right there, you see the range of yields is represented by the bar, and the black line shows you where yields currently are. The point being that, again, the yield pickup that you're getting from investing in emerging market debt in both hard and local currency or in high yield is fairly significant compared to what you're getting from other investment grade or treasuries. And finally, I just will tell you that the last slide here are implementation ideas that we have here on the iShares business for if you're interested in implementing any of these ideas with our different ETF tickers. And with that, I will hand it back over.